Hello, everybody. Welcome back. We are now joined by our final team of the day, Trees. So congratulations on making it to the final round of the MIPC. We are excited to watch your 10-minute presentation, after which we will move into a 20-minute Q&A. I will start my timer once the first person begins speaking, and best of luck.
Yeah, thank you, judges, and thank you, everyone, for being here. My name is James. I'm joined today by my teammates Sophia and Tony, and today we're going to be proposing our objective on board on a comprehensive net zero pledge and portfolio decarbonization plan. So the key issues we've identified moving forward is how we should define portfolio emissions, as well as the radicality of the decarbonization we must undertake to achieve net zero by 2050. We also have to consider maintaining risk-adjusted returns in addition to our sustainability progress, as well as the different investment strategies we must employ. So we've broken down our solution into 3 stages. Stage 1 will focus primarily on our portfolio shifts and reallocating our assets so that we can achieve good returns, risks, and sustainability. Stage 2, we will focus on future decarbonization, and so this is where we'll really make tangible steps towards reducing our carbon intensity. And in stage 3, we'll take on more actions to future-proof our portfolio, like our own green bond issuance, as well as continued advocacy for sustainability. So let's go straight into our stage 1. In the top left corner, you can see that we've broken down our stage 1 into 4 key action points. And the key aim we hope to address is to establish a balance of priorities between sustainability, returns, and risk, as well as achieve a tangible outcome in the reduction of fund carbon intensity, namely a 37% progress toward net zero. So in the first part of stage 1, we will divest from high carbon polluting industries like energy, materials, and utilities, which you can see in the top left make up a small percentage of sector weight, but contribute greatly to carbon emissions. So we want to invest into growing carbon-friendly industries like healthcare, information technologies, and financials, which have seen great pre-pandemic growth. And due to a variety of factors, we believe will continue growing from 2022 onwards. We want to further shift some of the investments around in real estate, infrastructure, and green bonds. And I'd be happy to elaborate more in Q&A, but for example, in infrastructure, we're seeing that Australia and New Zealand infrastructure investors, compared to other developed infrastructure investors, have very high volatility and lower returns. And this is because with new projects going forward, we really have to consider the additional implementations of new technologies, new transportation, energy infrastructures that makes the deliverables a lot more complex to navigate and takes more time to fully implement these infrastructure changes. Now, for the last part of our stage 1, we want to shift up our fund governance. So for example, our current fund manager compensation, like many firms, is comprised of a base salary and a bonus that's determined based off yearly performance. We want to incorporate a sustainability aspect that takes into account our fund's progress towards net zero so that we can demonstrate a commitment to net zero at the managerial level, which will flow down through our fund. We also want to enact a sustainable investment committee. These will be a team of 10 to 20 appointed investors, researchers, and industry professionals who, through their understanding of Super Easy's net zero plan and their expertise, can help alleviate some of the decision-making from our core investment committee. In the future, they can also take on additional tasks, such as in stage 3, where they will take charge of our green bond issuance. Tony, you're muted.
So stage 2 is further decarbonization by going beyond asset relocation. One thing we noticed through our research is traditional oil and gas companies tend to trade at a massive discount. And as such, price distortion would create opportunities for fundamental and contrarian investors. Furthermore, because those investors care less about sustainability, it will further lower the possibility or the speed of a successful energy transition. Another aspect of asset relocation is the risk profile. It will bring higher concentration on IT, healthcare, and financial, and will ultimately lead to a higher unsystematic risk. As a result, we think asset relocation alone is not sufficient to eradicate those issues. So we propose private equity investment along with the convertible bond strategies. In terms of feasibility, we think it's highly feasible because Super Easy have the ability to conduct due diligence and also have a strong bargaining power to enter those agreements. It is also very effective because PE investment will give Super Easy a higher control of the portfolio businesses to make impactful change within those organizations. Most importantly, it will bring positive value to the portfolio performance because private equity tend to perform higher than traditional public equity investment. Coming to the industry of high focus, we propose Super Easy to focus on material, energy, and industrial because these three sectors tend to have the highest marginal return in terms of decarbonization. And the action to take include the request for release of emission reports and to help our portfolio company to achieve a low carbon business model. And most importantly, we will propose a carbon offset to a reasonable range. Coming to the convertible bond strategy, it is specifically designed for emerging technologies such as sustainable energy and CCUS, because those businesses tend to have immature technologies and only targeting for a niche market. So we determined it is not likely to be commercialized in the near term. As a result, convertible bond strategy is a good financial vehicle to tap into those growth opportunity while mitigating the risk in the short run. Most importantly, a lot of the businesses in this sector actually generate a negative carbon emission. So by joining those companies to our portfolio, Super Easy can further decarbonize its emission. Coming to the analysis, we'll expect a 37% of emission reduction at the end of 2026 and a 53% of emission reduction at the end of stage 2. To the table to the right, we expect our Sharpe ratio to increase to 0.98 at the end of stage 2, subject to the change of both public and private equity return. We're more than willing to delve into our quant in the QA session.
Finally, the last stage of Super Easy's decarbonization plan is to future-proof its portfolio and to go into continued advocacy. And so the first part of stage 3 involves Super Easy establishing and issuing its own green bonds to speed up the development processes of ambitious climate project investments undertaken in the previous steps. And so specifically, the issuance of green bonds will allow Super Easy to add portfolio leverage from the low interest rates of the bond, as well as introduce more risk into the portfolio and thereby have higher returns. Specifically, the proceeds of the green bonds would go into backing environmentally innovative project investments in the project categories of renewable energy, pollution prevention and control, as well as energy efficiency. On the table at the bottom, you can see that focusing on these specific project categories will allow Super Easy to have some direct metrics that will allow it to measure its impact based off the proceeds of the bonds. To mitigate the risk of Super Easy not having been in the green bond market beforehand, Super Easy will also establish a sustainable investment committee that will meet once every quarter to monitor and evaluate the proceeds and the projects that the proceeds are backing. If you see in the top right-hand corner, I included a chart that compares the proportion of conventional bonds to green bonds issued by various Canadian pension funds who are currently leading in the green bond market. And as we can see, more pension funds are actually selling off their conventional bonds and shifting into issuing more green debt. As well, we believe that the green bond market itself is liquid and has enough depth to actually absorb another large institutional investor like Super Easy to come in. So overall, green bonds will allow Super Easy to build the capacity to deploy environmentally focused capital as well as fund green infrastructure. As well, Super Easy can demonstrate a commitment to the growth of the green market by becoming a repeat green bond issuer. The last part of the stage 3 is for Super Easy to future-proof its portfolio by taking an active stance towards sustainability, as well as voicing in support of green initiatives, as well as to go into advocacy by lobbying with portfolio firms for the Australian government to undertake more environmentally protective steps, such as shifting its economy away from its high dependency on fossil fuels at a sooner rate. At the bottom, we conducted a sensitivity analysis on the progress rate in stage 3 and found that at just a rate of 5% of decarbonization annually, Super Easy will be able to achieve a 97.6% reduction in their carbon by the end of 2050. So to conclude, today we presented you with 3 main stages in your decarbonization strategy. The first was an initial asset reallocation and as well as internal governance changes. The second was becoming activist investors in private equity and focusing on specific industries. And the third was to future-proof its portfolio for green growth through green bonds and shifting and going into advocacy. And by the end of 2050, we'll see that Super Easy will have reduced its weighted average carbon intensity to less than 100 tons of CO2 per $1 million in sales, whilst balancing its portfolio's expected returns and progress towards net zero. We'll now be open to any questions.
Wonderful. Thank you so much, team. Perfect timing. That concludes the presentation portion for trees. And now we will move into a 20-minute Q&A. So judges, please begin. Right, Jamie, take it away.
Thanks, team, for the presentation. I was wondering if it was possible to maybe elaborate more on the portfolio optimization, specifically honing in on how you arrived at, divesting from high-emitting sectors and infrastructure and real estate, and how do you rationalize that, given that these are sectors that have inflation hedging benefits and are also areas where we would likely be observing most of the innovation happening in the energy transition as well. It seems like a very, big active bet is what I mean to say.
Yes, for sure. So let's go step by step for this. So I'll first touch on IT, healthcare, and financials. So for that one, this is kind of the bulk of the action we want to take in stage one, right? And this was mainly because we've noticed that these, particularly in healthcare and IT, they've demonstrated strong growth in the past, and we're confident about their growth moving forward. For IT, like we're seeing more and more technological processes being implemented to optimize work in all industries, and we're seeing that the Australian government is investing more and more into its tech sector. Similarly with healthcare, with Australia being in stage 4 of its population pyramid and having a larger middle class that will transfer into a senior population within the next 10 to 20 years, it really, alongside the COVID-19 pandemic, it really puts a increased strain on the healthcare industry. And with a lack of skilled workers, it's essential for Australia to be able to continue investing into their healthcare sector, because even coming into COVID-19, we see that there was a lack of skilled workers in the trade, and especially after COVID, it's really highlighted the need for increased funding into this field of work. Now, so this would be the main aspect of our stage one. And as for the next slide, where we talk about real estate and infrastructure, this is kind of in addition to our divestment from high carbon polluting industries. For real estate, we're definitely not going to be divesting any of our 7% holdings within the fund, but instead we want to shift away from traditional real estate. We saw that due to the lowering interest rates and as well as the government initiatives such as the home builder scheme, there was a proposed something like 100,000 new houses being built, but only a quarter of those have been implemented. And we know that the 25% of remaining houses are sustainable development projects based on the life cycle assessment that we conducted. And so we see this as an opportunity for Super Easy to go in and either become, active managers of properties or just investing into property trusts, because there's a great opportunity for investment into sustainable property, which will help not only benefit our returns because real estate is a hedge, as you mentioned, but also it's quite safe going to a green form of investment for the future.
All right, thank you very much, team. Jamie, I hope that answered your question. Let's now move on to Francis.
Yes, thank you. I'd like to focus on phase 2, which, as you said, phase 2 relies on the fund being an activist investor. So I just wonder how deeply involved will you be in terms of being activist, and what changes to the portfolio it would lead to?
Tony, I believe you're muted.
So in stage 2, we mainly focus on material, energy, and industrial, because those sectors tend to have the highest carbon emission, and we can optimize the process by acquiring a majority of the voice in the chairs. So what we plan to do is really to kind of cooperate with our holding company, and some of the tangible action including requests for release of emission reports, as well as to kind of tailor and launch initiative that is unique to help the portfolio company to reduce their carbon emission in their day-to-day operation, as well as carbon offset, especially for some of the industrial and energy company. It is very achievable to have carbon offset. As a matter of fact, Shell right now have a CCUS project in North Alberta, and it absorbs a lot of its fossil fuels production process, like the carbon emission generated across in this process. So we think this are some of the tangible action we can take. Also, I just want to point out, we don't want to do this, but after acquiring majority of the share to the company, Super Easy do have the power and the right to more coercive approach to force the company to go green. So that is the kind of the action we will suggest Super Easy to take to help their portfolio to company to achieve decarbonization.
Thank you.
All right, thank you, team. Let's now move on to our next judge. Philippe, go ahead.
Hi. Well, first, congratulations for your great work on this very complex topic. My question is pretty simple. So you divest, your first step is to divest from high carbon intensity industries, infra and energy, but a large part or a very large part of the Australian economy is based on these industries. And my question is, how do you explain to your stakeholders and your clients that in many cases are maybe part of these industries, the way you will transition your portfolio, and why is it a good thing for them to do that?
Do you want to answer this, Tony, or I could go ahead?
Okay, you can go ahead.
Okay. Yeah. So if you go to the analysis slide, Tony. Oh, sorry. The slide for the stage 1. Yeah, thank you. You can see that we're not entirely divesting away from energy, utilities, and materials, because we do understand that these are some of the most important sectors for Australia. It's comprising a lot of its GDP. And as you mentioned, there's a lot of people who work in these sectors. But the public sentiment has been for not only the Australian government, but funds like Super Easy to move towards net zero. So what we wanted to try here is to maintain our investments in these high polluting industries to the point where they can kind of help sustain our returns, because we don't want to sacrifice on that on our journey to net zero. But the public sentiment has been pushing Super Easy to invest more into these green industries. But ultimately, we'll still be maintaining a relatively balanced portfolio by having somewhat of our investments still centered around these high contributing Australian industries.
All right, thank you, team. I hope that answered your question. Let's now move on to Mohammed. Go ahead.
Thank you. Excellent presentation. I have a question on the quantitative modeling for that supported the portfolio construction. So, and maybe more particularly on the long-term capital market assumptions that you used. Can you just share a bit of details on how you came up with the long-term capital market assumptions? I would expect that you probably use historical type of analysis, but my question would be, going forward and for projecting or a long term, how did you reconcile using historical data with the intent to project forward the asset mix?
Yeah, for sure. So in phase 1, our main concern is the industry, and the data we use, as you say, is the historical data of the past return. This is the standard deviation and the return we have, and it's 10-year annualized return. So what we do mainly is like using this data across our analysis. But what we do differently in stage 2 specifically is we add the impact from private equity as well as convertible bonds. We'll expect our private equity investment to increase from 21% to 36% of our equity portfolio, or 17% to 27% of our private equity of our like total AUM. And this is really the main driver of the kind of the financial benefit in our second stage, because private equity tend to generate a higher return, and we get the median return of 20% from the Harvard Business Review article, and the public equity invest return is just simply the long run S&P 500 return. So this is the kind of the key input data to forecast our return in the long run. I hope that answers your question.
And apologies, and maybe I should have asked the question in a better way. I was alluding towards, did you think about over the 10 years historical data that you use, whether the regime that we've been through is something that's going to replicate, or we're going to go through a regime change somehow over the next years?
Yeah, we didn't look into
my question.
Yeah, we didn't look into the specific quant data about like the future expected return of different industry, but we do some of the qualitative research, and through our understanding, we think energy transition is the trend right now. So the standard deviation might be lower because the green would be more stable investment to make, and the return will be higher compared to the traditional oil and gas industry. Another point we want to point out is the IT would also see an increase in the return, mainly because the kind of information transition we are facing in our society across different continents right now. So IT and energy is the two highlights of our key driver in the long run of our portfolio.
All right, thank you. I hope that answered your question, Mohammed. Let's now move to Paul. Go ahead.
Thank you. Thank you for a good presentation. I can see that your analysis shows slight improvements in returns and Sharpe ratio. I couldn't see any commentary on fees, so the scheme would need to remain commercially attractive to its customers. I just wondered, when you're looking at these more expensive components, have you thought about the potential impact on the management fees the scheme would need to charge members?
Sophie, I want to take this one.
Sure. So if you may, would you be able to repeat what specific fees? Are you talking about the fees overall in all the stages, or is it in a particular stage?
I was thinking that as you get into things like infrastructure and some of these sustainable renewable projects, the cost of investing in those asset classes is more than it would be if you were just in straight developed equity. So it's the cost that the consumer would pay. I just wondered if you'd factored in any impact on, would charges have to go up, I guess, would be the question.
Yeah, I can just, we definitely wanted to just kind of balance the returns in our portfolio, like despite, as you mentioned, the higher cost of investing into a sustainable infrastructure, real estate, like whatnot, and green bonds and stuff like that. But as for actually any metrics on how much the costs would increase for members, no, we haven't considered that. We were just mainly focused on just being able to balance returns, but definitely didn't think about the customer side of it for our pension fund.
Okay,
right.
Thanks.
Yeah, thank you, Paul, for bringing up that point. Why don't we now have a question from Audrey? Go ahead.
Hi, thank you very much for the presentation. I guess one piece for me that I thought was quite interesting was your stage 1 governance model. You are recommending Sustainable Investment Committee with 10 to 20 appointed investors, researchers, and industry professionals. That description makes me think that they're external to the organization. How do we see this external investment committee aligning and integrating with our internal investment committee and our already existing board?
Yeah, sure, I can take this one. So essentially, they would be external because in terms of sustainability, we want to have a committee that is especially have a good depth of knowledge in the world of green investments specifically. And so the investors would be able to kind of guide our this on, for example, whether what the impact of it would be on our overall pension fund and towards in the net zero. And another big part where the Sustainable Investment Committee would kind of integrate and play a big part is in the issuance of the green bonds in stage 3, because there are very specific guidelines that green bond issuances have to follow. And so they would play a big part in evaluating and monitoring which projects that the proceeds from the green bonds would actually back, and as well as the impact that the proceeds from the green bonds are actually having on the specified projects. Yeah.
All right, thank you very much, team, and Audrey for your question. I believe we still have some time left in the Q&A, 3 to 4 minutes. So if any other judges have any final questions, thoughts, comments, now is the time. Yes, Gareth, go right ahead.
Maybe a follow-up question on the activist and how you see that playing through, because you're going to have to take quite a bit of, quite a large stakes in companies, and therefore probably be more concentrated, and then align some of the other shareholders to the broader cause. How do you see that playing out more kind of practically?
Okay, for sure. So what we plan to do is to establish a system or an institution in stage 1 that will guide us through stage 2 and stage 3. But in stage 2, we specifically suggest to utilizing private equity strategy to tap into the energy transition opportunities and to help our portfolio businesses to achieve a low carbon emission kind of business model. So in Appendix A, this is the research conducted by McKinsey in 2007. And what it essentially states is it is possible to achieve carbon emission deduction without sacrificing the profitability of the company. So what we can do is actually tailor some very specific but also tangible plan to help our portfolio company to achieve emission reduction. So on the left-hand side, you can see there's like switching to LED. We can propose, for example, switching to LED or turn off the light after leaving office to our portfolio company to kind of decarbonize on their day-to-day operation. Another kind of approach we would take is to advocate for a very kind of systematic but also very transparent report system that can help others stakeholder in the company to kind of gauge how this company progress toward their net zero goals. So these are two of the main kind of focus we will be touching on.
All right, thank you very much, team, for your response. I see no other questions in the queue, so I think now would be a great time to wrap up our Q&A period. So thank you again, Trees, for your excellent presentations and for judges for your wonderful questions. Everybody, that now concludes all 5 presentations for the MIPC final round. And personally, I thought it was an amazing, insightful morning. I learned a lot. So I would really like to thank all of our judges once again for taking the time. Thank you as well to our top 5 teams chosen out of almost 100 submissions this year for their hard work and insightful discussion. And of course, thank you to all of you, our viewers tuning in today, for joining us at the competition. Our judges will now need some time for careful deliberation, so please take this time to relax. We will see all of you again at 2 p.m. Eastern Time for the finals award ceremony. Goodbye for now.